What if everything you've been taught about trading success is fundamentally wrong? What if those countless hours you've spent analyzing charts, following indicators, and chasing the next hot tip are actually keeping you from the results you desire? The truth about the markets might be harder to swallow than most realize. I've watched traders spend 12 hours a day glued to their screens, obsessively tracking every tick, convinced that sheer effort will eventually translate to profit. Has this ever happened to you? That feeling that if you just work harder, watch more closely, the market will finally reward your dedication? Here's the uncomfortable reality. The market doesn't hand out trophies for effort. It doesn't care how early you wake up, how many indicators you've mastered, or how dedicated you feel. The market rewards one thing above all else: discipline. And that discipline isn't about working harder. It's about understanding the real game being played beneath the surface. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Stay with me until the end, because what you're about to discover might completely transform your approach to the markets. The traders who consistently pull profits aren't necessarily the hardest working. They're the ones who've mastered their psychology and developed the discipline to follow their system regardless of emotional turbulence. Think about this. You could have a stunning 90% win rate and still blow up your account if those 10% of losing trades are catastrophic. I've seen traders celebrate their high win percentages while their equity curves tell a completely different story. The market doesn't care about how many trades you win. It only cares about how much capital you preserve and grow over time. This distinction between win rate and true consistency separates amateur traders from professionals. While the novice chases more wins, the professional focuses on proper position sizing, risk management, and emotional control. They understand that trading is a game of capital preservation first and opportunity second. What you're about to discover might surprise you. Some of the most successful traders I know place relatively few trades. They wait patiently for setups where risk is clearly defined and probability is heavily in their favor. They don't need constant action or the dopamine hit of entering trades. Instead, they approach the market with calculated precision, knowing exactly what they're looking for and having the discipline to wait until those conditions materialize. The real question isn't whether you can find winning trades. Almost any system can do that in the right market conditions. The true measure of a trader is whether you can maintain the discipline to follow your rules when everything inside you is screaming to do otherwise. When fear grips the market, can you still execute your buy signal? When euphoria reigns, can you still take profits according to plan? The transformation happens when you begin to recognize that the market itself has moods and temperaments just like people do. Some days it moves with the calm, methodical patience of a chess master. Other days it rages with the fury of a storm, whipsawing prices and punishing the unprepared. This isn't just a metaphor, it's the hidden truth about market behavior that most traders miss while they're fixated on technical indicators alone. Your journey to consistency begins not with strategy, but with observation. It's about developing the subtle awareness to read the market's language, to feel its rhythm, to sense its momentum, to recognize when it's whispering warnings that others can't hear. Think of it as learning to read between the lines of a conversation where what's not being said reveals more than the words themselves. If you value these trading insights, hit that subscribe button now to join our community of disciplined traders. I share proven strategies that can transform your approach to the markets. I spent years developing this awareness, watching how price moves in different environments, studying the relationship between volume and momentum, observing how support becomes resistance and vice versa. This deep observation revealed patterns that no textbook could teach me. The market has a language, and once you learn to interpret it correctly, you'll find yourself naturally positioned on the right side of trades more often than not. But here's where the real mindset shift occurs. Even with perfect observation, you'll still be wrong sometimes. The revelation that changed my trading forever was understanding that consistency doesn't come from being right all the time. It comes from doing the right thing after you're wrong. When the market tells you your position is wrong, what's your immediate reaction? Do you double down? Do you hope it will reverse? Do you ignore the message? These decisions reveal whether you're operating as a trader or a gambler. The trader listens to what the market is saying, cuts the loss quickly, and preserves capital for the next opportunity. The gambler fights the market, hoping to prove their opinion right, regardless of the impact on their account. Behind the scenes of every successful trading career is a trail of countless small losses taken without hesitation or emotional attachment. The ability to say, "I was wrong," and exit a position isn't weakness. It's the ultimate strength in trading. It's about respecting the market more than you respect your own opinion. I learned this lesson the hard way, holding on to losing positions far longer than I should have, watching small, manageable losses grow into account-threatening disasters. The psychological resistance to admitting error is perhaps the most powerful force working against traders. Your ego wants to be right, but your survival as a trader depends on being willing to be wrong gracefully and immediately. Now, I want to go even deeper into this topic and explore how this principle of accepting being wrong connects to another critical aspect of trading psychology, the management of winners and losers. Understanding this relationship is where the real art of trading begins to emerge. Drop a comment below with "The tape never lies" if you've ever experienced that difficult moment of having to admit the market proved your analysis wrong. I'd love to hear your experiences with this critical trading lesson. The secret to improving your win rate might shock you with its simplicity. It's not about discovering some hidden indicator that nobody else knows about. It's not about complex algorithms or arcane chart patterns. The revelation that transformed my own trading journey was understanding this fundamental principle: cut your losing trades faster and let your winning trades run longer. That's it. This principle sounds deceptively simple, doesn't it? But the psychological battlefield it creates is where most traders face their greatest challenge. Our innate human instincts work directly against this wisdom. We're naturally inclined to hold on to our losses, hoping they'll recover. While we rush to secure profits too early out of fear, they'll evaporate. This psychological paradox creates a powerful obstacle on the path to consistency. Behind every trading screen is not just a strategy, but a mindset being tested. When you're sitting in a losing position, watching your account balance decline, your survival instinct screams to avoid the pain. "Just hold on," it whispers. "It will come back." Meanwhile, when you see profits accumulating, that same instinct urges you to grab them quickly before they disappear. "Take what you can get," it suggests. Don't be greedy. But the master trader learns to override these instincts through disciplined practice. They develop the courage to face small losses immediately, while cultivating the patience to let profits accumulate beyond their comfort zone. This internal transformation doesn't happen overnight. It's forged through experience and conscious decisions that often feel uncomfortable at first. This leads us to another counterintuitive truth. Great traders learn to trade less, not more. In a world obsessed with constant action and immediate results, this wisdom feels almost revolutionary. The amateur believes that more trades mean more opportunities for profit. The professional understands that more trades often mean more exposure to mistakes and impulsive decisions. I've discovered that the most profitable periods in my trading career weren't when I was most active. They were when I was most selective. The real impact comes from waiting patiently for those perfect setups where price, volume, and trend align like planets in rare conjunction. These opportunities don't present themselves daily. Sometimes you might wait weeks or even months for them to materialize. This patience represents a profound mindset shift from the conventional approach. Instead of hunting for trades, you become a curator of opportunity, only engaging when the evidence is overwhelming in your favor. It's about quality over quantity, a principle that extends far beyond trading into every aspect of mastery. The market rewards this patience with trades that move decisively in your favor, with fewer whipsaws and false starts. It's as though the market itself respects those who respect its rhythms. When you align yourself with these natural cycles, instead of fighting against them, trading becomes less stressful and more profitable. I'm curious, have you experienced the struggle between taking quick losses versus letting winners run? Type "patience pays" in the comments if you felt the challenge of waiting for quality setups rather than forcing trades out of impatience or boredom. There's a powerful revelation that changed everything in my trading journey. Simplicity is the ultimate sophistication in the markets. If you look at the charts of most struggling traders, you'll see a Christmas tree of indicators, trend lines crossing in every direction, and complex systems that require a PhD to interpret. Behind the scenes, this complexity creates constant confusion and second-guessing exactly when clarity is most needed. The truth is, the fewer moving parts your trading system has, the fewer things can break down under pressure. I learned this lesson through painful experience, watching my overcomplicated approaches collapse during volatile markets when I needed them most. The transformation began when I stripped away everything except what was truly essential: clean price action, perhaps one or two reliable indicators, and most importantly, the discipline to execute consistently. This philosophy of elegant simplicity creates a foundation that can withstand the inevitable storms of market volatility. When your system is straightforward, you can make decisions quickly and confidently. You're not paralyzed by contradicting signals or overwhelmed by information overload. There's a clarity that emerges when you focus only on what matters most. Think about the most successful businesses you know. They typically do one thing exceptionally well rather than dozens of things adequately. Your trading approach should embrace this same focused excellence. Master one setup completely rather than juggling 10 mediocre patterns. This brings us to another mindset shift that separates professional traders from amateurs, treating trading as a legitimate business rather than a hobby or a gamble. The revelation here lies in how you view each element of your trading activity. Every position you take is essentially inventory with associated costs. Every loss you accept is a business expense. Every profit you secure is revenue. This perspective transforms how you approach risk management. No successful business owner would risk 20% of their company on a single product launch, yet traders routinely risk similar percentages of their capital on individual positions. The business mindset enforces discipline and proper capital allocation in ways that emotional trading never could. When you see yourself as the CEO of your trading enterprise, you begin asking different questions. Is this trade worth the capital I'm allocating to it? Does the potential return justify the risk? Am I diversifying appropriately, or am I overexposed in one area? These are the questions that lead to sustainable growth rather than spectacular but short-lived gains followed by devastating losses. The business approach also demands proper record-keeping and performance analysis. Just as a business owner regularly reviews profit and loss statements, You must honestly evaluate your trading results to identify strengths to leverage and weaknesses to address. This systematic review process accelerates your development as a trader in ways that random, unexamined trading never will. I've found that traders who embrace this business mindset experience a profound shift in their relationship with the market. Trading becomes less emotional and more strategic, less about the thrill and more about consistent execution. If you've realized that simplifying your approach might be the key to better results, type "less is more" in the comments. I'd love to know if you've experienced the clarity that comes with stripping away unnecessary complexity in your trading. One of the most powerful discoveries along my trading journey was understanding that consistency doesn't magically appear. It's deliberately cultivated through routine. Behind every chart pattern and price movement lies a deeper rhythm, the habits and practices that anchor successful traders during market turbulence. This revelation transformed my approach to the markets completely. Don't miss out on more trading wisdom. Subscribe now and be the first to access future videos that could make the difference in your trading journey. Your daily trading routine serves as the foundation upon which sustainable results are built. The ritual of waking up at the same time, reviewing markets in a systematic way, and approaching each session with clear intention creates a framework that prevents impulsive decisions. These structured habits become especially crucial during periods of heightened volatility when emotions threaten to overpower logic. I've found immense value in developing a pre-market routine that prepares both my mind and my strategy for the day ahead. This might include reviewing overnight news, checking key levels on my watch list, and most importantly, setting clear parameters for what constitutes a valid trading opportunity for that specific day. The consistency of this preparation process creates a psychological anchor that keeps me grounded when the market opens and emotions kick in. Perhaps the most underrated aspect of a successful trading routine is comprehensive record keeping. I don't just mean tracking your entries and exits, though that's certainly important. The true insight comes from documenting your mental state during each trade. Were you calm and following your plan? Were you trading out of boredom? Were you chasing after missing an entry? These psychological patterns, once identified, become the roadmap for your improvement journey. The discipline of maintaining this trading journal creates a feedback loop that accelerates your growth. You begin to recognize the subtle psychological triggers that lead to poor decisions, allowing you to intervene before making the same mistakes repeatedly. This self-awareness represents one of the most valuable assets any trader can develop. Now, let me share what might be the most counterintuitive wisdom I've gathered throughout my trading career: the incredible power of doing nothing. In a world that celebrates constant action and visible progress, the discipline to remain still and patient runs against our cultural programming. Yet, it's precisely this capacity for strategic inaction that separates consistently profitable traders from the crowd. The hidden truth is that most traders don't lose money because of poor entries. They lose because they can't resist trading during unclear market conditions. They feel compelled to be active, to justify their screen time, to prove their skills. But the market doesn't reward activity. It rewards appropriate action at the right moment. Learning when not to trade is just as important as knowing when to enter. Choosing to stand aside when conditions are choppy or unclear isn't passive. It's an active decision that preserves your capital for better opportunities. This patience keeps you out of the frustrating chop that grinds down accounts through 1,000 small cuts. I've come to see waiting as a positive skill rather than a passive state. The ability to sit in silence while others frantically trade is not a weakness. It's the ultimate display of control and discipline. Some of my most profitable periods came directly after extended times of minimal activity, where I preserved capital during difficult markets and deployed it aggressively when conditions improved. Have you noticed how difficult it can be to do nothing when the markets are open? Comment strategic patience below if you've experienced the challenge of waiting for perfect setups while watching others actively trading around you. Let's explore a powerful metaphor that revolutionized my understanding of the markets. Imagine a successful shopkeeper for a moment. They carefully manage their inventory, knowing exactly what's on their shelves, what's moving quickly, what's stagnant. They track their costs meticulously and understand their profit margins on every item. They don't become emotionally attached to products that aren't selling. They mark them down, learn the lesson, and allocate that shelf space to something more promising. This is the exact mindset that transforms struggling traders into consistent performers. Until you handle your trades with the same clinical precision as that shopkeeper manages inventory, you'll continue to experience the emotional roller coaster that destroys capital. Your positions are your inventory. Your losses are your costs of doing business. Your winning methodology is your product, and your disciplined execution is your competitive advantage. The revelation here is that emotional detachment, the ability to view your trading activity through this objective business lens, creates the foundation for sustainable success. When a position moves against you, it's not a personal failure or an attack. It's simply inventory that isn't performing as expected. The rational response is to minimize the cost and reallocate that capital where it can work more effectively. Behind the scenes of every consistently profitable trading career lies this fundamental shift in perspective. The amateur takes losses personally. The professional sees them as unavoidable business expenses to be managed efficiently. This single mindset transformation can bridge the gap between frustration and consistency faster than any technical indicator or trading strategy. Now, I want to go even deeper into this topic by exploring the critical relationship between risk management and humility. There's a hidden truth that many traders resist acknowledging. Capital protection starts with risk management, and risk management starts with humility. The market doesn't care about your analysis, your convictions, or your needs. It moves according to its own complex dynamics, often in ways that defy even the most sophisticated predictions. The journey to trading mastery requires accepting that you will be wrong often, sometimes spectacularly so. The question isn't whether you'll be wrong, it's how you'll respond when you inevitably are. Every trader who believes they're smarter than the market eventually learns this lesson, usually through painful financial consequences. I've witnessed brilliant analysts with impeccable theoretical understanding blow up their accounts because they couldn't accept being wrong. Their expertise became their downfall because it fed their ego rather than informing their risk management. Meanwhile, I've seen traders with average analytical skills build substantial wealth simply because they approach the market with appropriate humility and disciplined position sizing. This humility isn't weakness, it's strategic strength. It allows you to stay flexible, to adapt when conditions change, to cut losses without emotional resistance. The market constantly evolves, and only those who can evolve with it survive long-term. The path of the rigid ego leads inevitably to ruin, while the path of humble adaptation leads to sustainability. If you've ever found yourself fighting the market to prove your analysis correct rather than accepting what price was telling you, type humble trader in the comments. I'm curious how many of us have learned this lesson the hard way. There's a quiet truth in trading that gets overshadowed by stories of spectacular gains and overnight millionaires. The path to consistency isn't paved with those headline-grabbing home runs. It's built through the disciplined practice of taking small, controlled losses while fiercely protecting your capital base. This revelation completely transformed my approach to the markets, and created the foundation for sustainable success. Think about the mathematical reality behind this principle. The money you don't lose compounds at exactly the same rate as the money you make. Yet most traders focus obsessively on finding winning trades while neglecting the equally important discipline of minimizing losses. Behind the scenes of every long-term trading career is a meticulous approach to risk that prevents the catastrophic drawdowns that destroy most trading accounts. I discovered this wisdom through painful experience, watching positions I should have exited quickly grow into account-threatening disasters. The psychology behind holding losing trades too long is fascinating. We become emotionally invested in being right rather than being profitable. This emotional attachment creates a blind spot that prevents rational decision-making exactly when clear thinking is most crucial. The journey to consistency requires developing an almost philosophical detachment from individual trades. Each position becomes simply one of hundreds you'll take throughout your career, none particularly special or worth defending beyond its mathematical merit. This mindset liberation allows you to cut losses with surgical precision, without the emotional resistance that typically accompanies admitting you were wrong. Now, I want to go even deeper into this topic by exploring a fundamental mindset shift that accompanies this approach to capital preservation. When you truly internalize the importance of protecting your trading capital, you begin seeing every potential trade through an entirely different lens. Instead of asking yourself, how much can I make on this trade? You start with, how much can I lose if this goes wrong? This perspective transformation changes everything about how you approach the markets. Your analysis begins with identifying potential failure points rather than profit targets. Your position sizing becomes a careful calculation of risk exposure rather than an expression of confidence. Your entire decision framework shifts from hope-based optimism to calculated probability management. I remember the exact moment this shift clicked for me. I was reviewing my trading journal and noticed that my biggest losses didn't come from bad analysis. They came from improper risk management on trades, where I was actually correct about the direction, but wrong about the timing or magnitude. The revelation wasn't that I needed better analysis. It was that I needed better risk control, regardless of my analysis quality. When you approach each trade by first understanding exactly what you stand to lose, you gain a powerful sense of control that hope-based trading never provides. You're no longer at the mercy of market movements because you've already accounted for adverse scenarios. This clarity creates a calm, professional approach that stands in stark contrast to the emotional turbulence experienced by traders focused primarily on potential rewards. If you've experienced that moment of clarity when you realize protecting your capital matters more than chasing the next big winner, type capital first in the comments. I'm curious how many of you have made this crucial mindset shift in your own trading journey. Let me share a profound insight that completely reshaped my understanding of the markets, the realization that prediction, which most traders obsess over, is actually the weakest part of trading. Observation, on the other hand, is the strongest. This revelation marked a turning point in my trading journey, shifting my focus from trying to forecast where prices would go to simply understanding what they were already doing. Think about the fundamental difference between these approaches. Prediction says, I know what will happen next. It's rooted in ego and the illusion of control. Observation says, let me see what's happening now. It's founded in humility and genuine understanding. This philosophical distinction creates an entirely different relationship with the market, one based on receptivity rather than imposition. The breakthrough comes when you stop fighting the market's message and start truly listening to it. Behind every price movement is a story being told about supply and demand, about sentiment, about institutional positioning. The chart isn't something to be conquered, it's something to be read and understood. The tape always speaks the truth if you have the patience and clarity to listen. I spent years developing elaborate predictive models, searching for the perfect indicator combination that would forecast market moves with certainty. What I discovered instead was that my most profitable trades didn't come from prediction at all. They came from carefully observing how price was already behaving and aligning myself with the existing momentum. The distinction transformed not just my results, but the entire experience of trading. When you truly embrace observation over prediction, you develop an almost intuitive sense for market rhythm. You begin to notice subtle shifts in behavior, how volume expands before significant moves, how price respects certain levels, how the character of the market changes before reversals. These insights can't be programmed into an algorithm. They must be absorbed through patient observation over time. Now, I want to go even deeper into this topic by exploring how this observational approach connects directly to patience in execution, arguably the most underrated trading skill of all. Most traders lose not because they lack knowledge, but because they trade too soon, jumping into positions before moves confirm. The disciplined observer understands that waiting for confirmation doesn't mean missing opportunity. It means reducing false signals. I remember watching a particular stock for weeks, observing its behavior as it consolidated in a tight range. While others jumped in and out on minor fluctuations, I waited patiently for the pattern to complete, for volume to confirm the breakout, for price to demonstrate real strength. When that moment finally came, the move was decisive and sustained, precisely because I'd given the market time to reveal its true intention rather than forcing my timeline onto it. This patience in execution requires a profound inner transformation. It means overcoming the fear of missing out, the need for constant action, the desire to prove your analysis correct immediately. The market operates on its own schedule, not yours. The trader who accepts this truth and aligns with the market's timeline rather than fighting it gains a significant edge over those driven by impatience. If you've experienced that moment of clarity when you realize that waiting for true confirmation led to better trades than jumping in early, type "observe, don't predict" in the comments. I'm fascinated by how this principle manifests in different trading approaches. As we wrap up this exploration of trading wisdom, I want to thank you for taking this journey with me. The principles we've discussed, from discipline over effort to the power of observation, aren't just trading concepts. They're transformative approaches that can reshape your relationship with the markets entirely. If you found value in these insights today, consider becoming part of this community by hitting that subscribe button. I'm committed to sharing the kind of nuanced, experience-based trading wisdom that goes beyond the surface-level advice you typically find elsewhere. I'd love to know which of these principles resonated most strongly with you. Drop a comment with "Market Wisdom Received" if you made it to the end, and share which concept you'll be implementing in your own trading approach. Your perspective might help another trader who's facing similar challenges. And if you found this conversation valuable, that like button is a simple way to let me know this content connected with you. It also helps other traders discover these ideas when they need them most. There's a video right here that builds directly on these principles, exploring how to create a personalized trading framework based on your own psychological strengths. Click and continue with me over there as we take these concepts even deeper. Remember, the market rewards those who approach it with discipline, patience, and humility. I'll see you in the next exploration.